Hello, and thanks for tuning in today. I do appreciate it. In this video, we are going to look at gold's continued price climb and the potential for it to break a new record soon. We'll also look at the dollar index and the dollar reserve's currency status. Please keep in mind that nothing in this video is financial advice. Oren Elbaz, also known as the Silver Hermit on X, YouTube, and Rumble, is here with me today to break down what is going on in the gold and silver markets right now. Oren, welcome back. How's it going today?
Hello, everything's fine. Thank you for having me.
Absolutely. It's always great to have you on. Gold is rapidly approaching its inflation adjusted all time high of $3,486 per ounce, with its price sitting less than $150 below that inflation adjusted all time high right now at about $3,342 per ounce. And Goldman Sachs recently increased their gold price projection to $3,700 per ounce. It does seem very likely we could see gold pass its inflation adjusted all time high in the coming months. Oren, what do you think about gold's recent price action?
Well, first of all, what a difference like a couple of weeks make. I mean, like you and I were here a couple of weeks ago talking about the fact that the markets were in a state of meltdown and the price of gold and silver was falling.
Yes.
And and here we are just, such a short period of time later, and it has gold has completely reversed that initial decline. It set new all-time highs, and it's just charging higher and higher. It was incredible to watch. We've had like $100 up days,
Yeah.
which is unheard of. And now we're asking ourselves, is this a top? Is this a temporary top? It's just a small pullback, perhaps a consolidation. I think the price of gold is definitely going to rise much higher in the coming years. But right now, what's going to happen in the coming days or weeks, I really can't tell.
Yeah, it's hard to say if we might be experiencing a pullback coming up soon. It has been impressive to see it break high after high, week after week. And it has just kept rising, even though the markets have taken a big hit. Um, the US dollar, which we're going to get into here in just a moment, has taken a hit, and gold just keeps charging higher. I
I
do
want to
think,
point out that technically speaking, gold doesn't have many hurdles or boundaries. It's above all those trend lines which kept it down in recent years. And so when you actually find some technical boundaries, such as the inflation adjusted top of 1980, then it's like an opportunity for whoever is bearish on gold to say, aha, this is the moment in which it will put in a top and perhaps pull back. This is an opportunity for the big banks, for instance, to slam it down. I think this is exactly what we saw yesterday. This was like it reached it very briefly. It reached $3,500, and this was like the moment. This was like the cue to
to
slam it
slam it.
down. I think this, yeah.
Hmm. Well, what's interesting with gold is what's really been driving it right now is the big banks, the big mystery buyers in North America, all the central bank buying over the last few years. It's been really noticeable. Although I don't think that there's been much demand from regular investors still at this point. And if they start piling into it, and it's got to be coming because it's showing up on the news now. Yahoo's reporting on gold. It's coming. People are going to start paying attention, and so I have a feeling it's going to keep going up. Maybe for the next year or two. I'm not sure exactly. And yeah, we'll have some pullbacks here and there, but I have a feeling that we are going to see it pass its inflation adjusted all time high before too long here. And I think gold still has a lot of runway to go up.
There are all sorts of indications that gold still has room to run, and we never know. It could enter a consolidation for a while. It can always happen. The market is just so volatile, it's almost impossible to tell. As always, I try to focus on the long term. I think that gold is still relatively cheap if I compare it to the money supply, if I compare it to, as we said, inflation adjusted. So it still has room to run.
Absolutely. And who knows? The central banks might keep buying it at the pace that they have because of all the uncertainty internationally right now with the tariff situation. And so if that pressure does not get relieved and the investors start piling in too, this might go on for some time.
Yes. Another indicator which I forgot to mention, I tweeted recently that if you compare it to the CRB commodity index, there's a very nice pattern there which allows it to continue rising compared to other commodities.
So there's another indicator that it'll keep going up. Well, since the beginning of the year, the DXY or US dollar index has dropped by about 10%, and it has just recently dropped under 100. So, what is the dollar index and what does it really mean? Well, the DXY measures the strength of the US dollar by comparing it to six other major currencies. These currencies are the euro, the Japanese yen, British pound, Canadian dollar, Swedish krona, and Swiss franc. The DXY was initially created in 1973. And the way that it measures the dollar's strength is that when it's at 100, it's indicating that it's at the same value as it was when it was created. And if it drops below that, then it's weaker. So what affects the DXY? Is it, I mean, is it all these things? Is it interest rates that the Fed puts out, job numbers? It does seem to me like right now, like tariffs or fear of conflicts are driving it.
Yes. So the dollar index, as you've mentioned, is an index which measures the value of the dollar compared to other fiat currencies around the world. Now, it's mainly the euro. The euro consists more than 50% of that index. And then you have the Japanese yen and the British pound, which are also important. But basically, you're comparing the dollar to other fiat currencies. Now, notice that you're not comparing it to commodities. So when the dollar index rises, it means that the dollar is stronger compared to other currencies and not compared to commodities. Doesn't necessarily mean that it has a higher purchasing power. The dollar index can strengthen as the dollar is losing purchasing power. And that is very important to notice because just because the dollar index has been strong in recent years doesn't mean you don't have inflation.
That
Now,
is a good
that's the
point.
first, yeah, that's the first thing that you need to be aware of. And okay, so in recent years, we've seen it strengthen. It was stronger. It went above 100, and people thought it's going to continue going up. And the reason why it was stronger is because the Fed was tightening its monetary policy, raising interest rates, performing QT, which is the inverse of QE. It wasn't printing money. On the contrary, it was destroying money. It was like burning money. That's the meaning of QT, quantitative tightening. And so, the public believed that the dollar should be stronger compared to other currencies. But now, what's happening is that, well, first of all, the Fed is no longer tightening. It has even eased monetary policy a little bit. And people are, due to the current weakness in the markets, people are even suspecting that the Fed is going to start easing again. Um, and so perhaps this is what's responsible for now the dollar weakness. But also, I think that the most reasonable explanation of why the dollar is now weakening is reduced demand across the world for financial assets such as stocks and bonds, American stocks and American bonds. Well, first of all, because the stock market has been weak since the beginning of the year, so perhaps people are bailing out of the S&P 500 and then the Nasdaq, and also perhaps they're also selling American bonds because there's just, the Treasury needs to refinance a lot of debt in the coming year, and trillions of dollars need to be refinanced, probably at higher interest rates. And I'm guessing that there is a fear that the market is going to be flooded with new debt, and the market value of that debt is going to drop. So I think people are just bailing out of the bond market, and that's my best explanation as to why the dollar is weakening. They're selling those assets and using the proceeds, buying their local currency, so they're selling dollars.
That makes sense. And it does look like the Fed is going to do some easing. My understanding is it's a pretty high likelihood that they'll do a rate cut this summer. Some are considering it like baked in at this point, for them to do a rate cut this summer. And what's interesting is back in about 2001, well, over 70% the central bank's reserve currencies were in US dollars, and that's dropped down to like about 59% today. So we already kind of see it trending that direction. Um, the foreign governments are trying to get away from the dollar, and all this stuff that's going on with tariffs might just exacerbate that. It might just make it move along quicker.
Yeah.
Um,
So what's important to note is that the dollar index fell below the level of 100, which I
okay,
think is a critical level because it's like this round number,
right.
which served as support in the past couple of years. And once you fall below, as though below the floor of 100, then it can accelerate. Potentially, I think the dollar index in the coming months or years, it can fall as low as 90 or even lower.
So another
And that,
10% or maybe more from here.
yes, yes, I see, like technically speaking, there is the potential for that. And that is very problematic because we are currently expecting a surge in inflation due to the tariffs, by the Trump administration.
Right.
And if on top of that, you also get a weakening currency, that means you need more dollars in order to purchase the same products if they are manufactured abroad.
Right.
So
Absolutely.
that's another driver for inflation. So you get that double whammy of both having those tariffs and a weaker dollar. So in the past 2 years, a strong dollar was, it reduced the amount of inflation that Americans felt. It as though gave them some kind of a reprieve because you needed fewer dollars in order to buy imported goods. And now it's going to be the reverse of that. It's going to be the reverse effect of having to pay more dollars in exchange for the same amount of foreign currency, the same amount of imported goods. So you get inflation both from tariffs and from a weaker dollar, and that's kind of dangerous.
I see. So the dollar, because it was strong, was kind of working as a counterbalance. And now that it's turned in the other direction, um, now it's like a double-edged sword for us.
Yes, exactly. Now, what's interesting to mention, in that regard, is what we call the milkshake theory. Now,
Yes.
this is a theory which was created and popularized by an analyst called Brent Johnson of Santiago Capital. And he's very active on Twitter, talking to people. I've had discussions with him in the past, and he has been arguing for a number of years now that the dollar index is destined to rise dramatically. And the reason for that, or the explanation that he gives, he argues that there is a dollar shortage
I see.
across the world.
Uh-huh.
Usually we are talking about, money printing here in the US, that the Fed prints money. We don't think of dollar scarcity as a thing.
No.
But he argues that across the world there is a scarcity of dollars, and the reason for that is that um, of the around 300 trillions of debt, $300 trillion worth of debt across the world, he argues that about a half of it is what we call dollar denominated debt. It's denominated in dollars. So all those corporations across the world owe dollars. And in order to service that debt or try to repay it, they need dollars all the time. There's this constant demand for dollars, by corporations across the world. And this is as though what is supporting the US dollar, giving it strength. Now, of course, when the dollar index, when it went above 100 and started surging, then everybody in the investment world started thinking, whoa, Brent Johnson was right.
He
Look,
was correct.
we're seeing the milkshake theory materializing before our very eyes. It's just happening. And he became very popular as a result. Yes, he was very popular in recent years. And I have to look, personally, I never bought that theory. And I'm going to tell you why, because there's something a bit counterintuitive about it. Like, according to the milkshake theory, the world can never de-dollarize. Do you
Right.
understand? Do you
Yeah.
understand why?
Because they'll constantly have to be servicing this debt that's denominated in US dollars. So they want to,
Yes, yes, exactly. Because if they, for instance, if you're, I don't know, a corporation from Indonesia, and you've borrowed dollars in order to buy machines to set up your factory to, I don't know, produce underwear to sell them in the US or in the European Union. And you owe dollars, then you constantly need more dollars to service that debt. And if you try to pay it down, what happens is, since we're living under this debt-based system, once you pay down debt, you as though destroy dollars. Dollars are created when you take debt and destroyed once you repay it. So if you try to get rid of that dollar denominated debt, you're as though reducing the amount of dollars in circulation and making them more valuable. You see?
because there's less of them.
Yes, because there is less of them. And so it becomes more and more difficult to pay down the debt. The more you try, the more difficult it becomes to pay down that debt. That's his main argument, that um, as though the world can never de-dollarize because
Right.
that debt is going to prevent it from happening. And to me, that's very counterintuitive because it as though means that the dollar will always be the global reserve currency, and there's nothing that foreign countries can do in order to change that.
Yeah, that's definitely what he was hinting at.
Yes, and it also means that you can never have a dollar collapse or a hyperinflation in the dollar because the moment people try to ditch the dollar, it becomes more expensive. It becomes more valuable. So it counteracts any inflation that you have here in the US, as though you can never have the dollar collapse.
The world is just going to be relying on US dollars till humanity ends.
Yeah, forever and ever. And
Right.
no matter how many dollars the Fed prints, the world is always going to soak them, always going to take them because it constantly needs more dollars.
Right. That's
So
the theory.
that's the gist of it. That's the gist of the theory. And I always, I couldn't quite explain why, but I just didn't buy it because it doesn't make any sense to me that that a country can print like unlimited amount of dollars and foreign countries will always take them no matter how much you print.
Right. It doesn't make any sense to me either. I've never thought much of the dollar milkshake theory.
Yes. And then it dawned on me, not a long while ago, by the way, it dawned on me that there is an explanation, there is a way to settle this contradiction, and this is through the velocity of money. Yeah, I know it sounds a bit complicated, but it isn't. The
Okay.
velocity of money is simply the number of times in which those dollars exchange hands in any given period of time. For instance, look, I get paid, let's say in dollars, and I go out to a restaurant and I pay the restaurant with those dollars. And, the restaurant owners uses that money to, pay his suppliers. So every time those dollars exchange hands, that's like you count one, two, three times, and you measure how many times they exchange hands, let's say during a single year. So when you measure inflation or when you talk about inflation, you need to think not only about the quantity of dollars in circulation, but also about their velocity. Because when those dollars circulate faster, it feels as though there are more dollars in circulation. Do you see what I mean?
Oh, no, absolutely. Because if it's not just being held by a central bank as part of its reserves, and they offloaded it, and now there's more dollars in circulation, almost just like printing more money.
Yes. Now, a way in which you can think about it a way to illustrate it. Let's suppose that the Fed were to print like $1 trillion and just sit on them, shove them under the table and do nothing with them. Then
Okay.
it's as though they don't exist. You see what I mean? Like
Right.
officially they printed them, but if they're not in circulation, then they're not affecting the prices of goods and services.
Absolutely.
So this is as though money which has zero velocity.
Yeah, it's not changing hands at all.
Yeah. But if you take that money and you start, injecting it into the system, giving it to people who can actually use it to buy goods and services, to go to the supermarket, to pay their rent with it, to pay their utilities with it, suddenly it does affect inflation.
Because
Suddenly yeah, it
there
starts
is
bidding up.
more.
Yeah, it starts bidding up the prices of all those goods and services. So the velocity is just as important as the money supply, as the quantity of dollars in circulation. And what economists do usually, they assume that the velocity is constant.
I see. Okay.
And I think that's a mistake. I think what we're seeing nowadays, um, or what we could see, is that if countries across the world lose faith in the dollar, and they start, try to ditch the dollar, what's going to happen is that the velocity is going to pick up. People are not going to want to hold dollars. I mean, even if they do get dollars in exchange for their product, they're going to try to get rid of it as quickly as possible. And this means that its velocity is growing faster and faster.
Right, absolutely. That totally makes sense.
And so even if they pay down debt and the number of dollars in circulation is falling, but if the velocity is growing at the same time and growing even faster than they are paying down debt, then you could have the amount of dollars falling and yet the feeling, the effect of more dollars in circulation.
Right. And that's out of the Fed's control too. And a stated goal of the BRICS is to de-dollarize. I
Yes.
think all those countries saw us freeze the Russian assets and they all thought, we don't want to end up in the position like Russia is right now. So they are attempting to do this. And a lot of those dollars will get put back into the money supply and affect the velocity. That totally makes sense, what you're saying.
Yes. And so if you reach that point in time, you've said it correctly. If you reach that point in time in which people are trying to ditch the dollar and the velocity is picking up, then it's out of the control of the Fed because the Fed can increase or decrease the amount of dollars in circulation, but it cannot affect the velocity. And so even if they try to, contract the money supply as velocity is picking up, we can reach a point at which it doesn't help. And another point to consider is that if no one wants dollars, then they're going to end up back in the United States because this is the only place in the world in which corporations have to take dollars. They cannot
Right.
refuse to take dollars. So all those dollars are as though all the dollars which were exported, in recent decades are going to find their way back home. And I think they're going to, it has the potential to generate such terrible inflation that we 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 almost cannot imagine.
I bet a lot of those dollars are going to find their way back to the United States. And a good way to prepare yourself for that would be to get some physical gold and silver.
Yes. And in my mind, this is the end game for the dollar. I don't know, I don't know for sure if it's ever going to happen, but this is the most plausible theory that I can come up with in order to explain how the dollar can collapse or how the world can de-dollarize in spite of all that dollar-denominated debt across the world. Now, half jokingly, I call this theory the whiskey theory.
I like it.
It's not the milkshake theory, it's the whiskey theory. Because once you realize what can possibly happen if all those dollars come home to roost, you're going to have to pour yourself a stiff drink in order to relax.
Absolutely. And luckily, we do have plenty of whiskey distilleries here in the U.S. Tennessee area is famous for those. So we got some here in the States that you could spend those dollars on too for that inflated
Definitely.
whiskey.
Yeah, whiskey is going to be a very good investment in coming years.
Yes, that will be something that will make you want to have a stiff drink for sure. Well, I think that if the dollar index breaks down further, and let's just say it does go another 10% down or maybe a little more, like you're talking about, it seems to me like this will be really bullish for the metals because people will want to access that store of value that silver and gold can provide. And when they're looking around, it looks like the stock market, isn't doing great, that there's only going to be so many places for them to park that money. And so it wouldn't surprise me if the dollar index does keep breaking down, if this will be bullish for the metals and we will see some regular investors start moving into the gold and silver sector that potentially hadn't before.
Yes. And I would also say that, since gold has become so, so volatile, it's been rising this way, perhaps it's trying to tell us something. Perhaps it's signaling that this process has already begun. I'm like suspecting that we're in the initial stages of that de-dollarization. Or, an interesting thing to mention is
Uh-huh.
that China has just performed an experiment with its new payment system, cross-border payment system.
Okay.
And yes, and they are able, since their infrastructure is up to date, they are able to perform and to clear a payment, a cross-border payment within seconds.
Whoa.
And you compare that, for instance, to the Swift system, in which it can sometimes take you 2 or 3 days to clear a payment. It's crazy. I don't know how many of you have ever tried to wire transfer money to another country. I've done that several times, and it can actually take me like a couple of days to transfer funds uh, from here, from Israel to Europe.
Interesting. I know I've never tried to wire money overseas.
And it's kind of crazy that in our day and age, when we have such advanced computer systems, it's going to take so long. Now, I don't know exactly why it takes so long. Perhaps it has to do with regulations, or perhaps the people who are in charge of that system, they didn't bother to update it because it was working, and it worked for so long, and it was the gold standard of wire transfers, that nobody thought to modernize it and improve the infrastructure.
That could definitely be it. And who knows, maybe they will try to improve it now that they see China has a superior version of it. But I mean, maybe not. It's kind of crazy to see um, China, who's considered to be a developing economy, with these high-speed rails going all over their country. Um, we don't have any in the US that are mentionable, and we're constantly just sending money to all these other countries in the form of foreign aid. And so the West makes some surprisingly bad decisions, and who knows, maybe they'll just leave it as is.
I think the West was a bit too complacent, and the West also supported the modernization of China through its trade policy for many years. The West, of course, enjoyed from that policy because, America got cheap consumer goods from China, which otherwise it would need to pay more for. But the implications of that is that now China is a manufacturing powerhouse, and the United States isn't any longer. And in order to reverse that, it's going to take a number of years of, investing and recreating that industrial base, back at home. And Trump,
Absolutely.
yeah, this is what Trump is trying to do, and I hope he succeeds. But it's going to be painful because as we said, short term it means higher prices.
Yeah, and I do think it'll be painful for both countries. China has all these big manufacturing facilities that are basically reliant on U.S. consumers, especially for some things. Like let's say a Christmas tree factory in China. The vast majority of those Christmas trees are going to get sold in the U.S. They're all going to get shipped over here. So China doesn't have a good market replacement for the US right now, and we can't manufacture anything. So it's kind of like neither of us were ready for this at this stage.
Well, factories are going to retool in China. I mean, factories are going to find new markets, perhaps not make as much money as they used to, but they're still going to go on, and factories are going to pop up here in the United States in order to manufacture all these things that are, too expensive to import from China. The market is going to adjust. It's just going to take time.
Thank you for your thoughts on that. The gold to silver ratio is totally out of whack right now. It's unusually high at 104. Not to say that it can't go higher than that, but I do see this as a buying opportunity for silver. Over the last 20 years, it's spent a lot of time under a ratio of 70 to 1. So I really believe that we will see it snap back down to at least 70 to 1 at some point. If we had that ratio right now, silver would be about 47.72 per ounce, but it could go much lower than that. In the last 20 years, we even saw it drop below 40 to 1. But let's just say if it got to 50 to 1 right now, because of, let's say, investors moving into silver trying to get away from a weakening dollar. Well, if we had a GSR 50 to 1 right now, silver would be $66.82 per ounce, basically double where it is right now. What do you think about the gold to silver ratio being up at 104 right now?
Yes, it's very sad to see it rising this way. It's very sad to see the price of silver so stagnant when the price of gold is setting new all-time highs like that. And it gives you, it illustrates just how managed the price of silver is when you see that the price of gold is so volatile and the price of silver just doesn't move, doesn't budge, can't get over 33.
Right, it
It's
is depressing.
it's amazing to watch because it feels so artificial. It feels so, blatantly artificial.
Absolutely, totally in your face. Like it doesn't make sense that it's where it's at right now.
Yeah, if you ask me, I think it reeks of desperation. I think the people in charge of that market are, they're desperate because they've been caught short and they thought that they're going to have the opportunity, for instance, during a market downturn, to, offload those short positions. But what we've seen is like this very rapid dip. And, suddenly the price of gold is at new all-time highs, and supposedly the price of silver should follow. And they can't let it run because they're trapped short. And I think there are some people out there who are scared. And I think what we're seeing right now is like the desperation. um how
I,
long can it last? I don't know, but not forever. The current gold to silver ratio is unsustainable. We haven't been this high. We've almost never been this high. You have very short periods in history in which the gold to silver ratio was above 100. It usually doesn't last for long. Now, of course, as you said, it can go higher, of course. Um, but eventually it's probably going to break down, and we're probably going to see some kind of a surge in the price of silver, and we're probably going to see it following gold. And I think that at least, you know, at least don't sell your silver. I'm buying more, by the way. Just a handful of ounces here and there. I'm buying more, and I'm guessing that you do too.
yes, I'm still adding, and with the gold to silver ratio being this out of whack, I've really been more interested in silver recently. I really do think that we'll see a breakdown in the ratio, and I do think that we'll see silver move into its bull run. And I agree with you. I think it does seem completely desperate. I read an article a few months ago that the bullion banks are short about one half of 1 year worth of silver supply. So that's a massive short position, and it seems totally desperate to me. And the thing that frustrates me too is these big banks, when they make poor decisions and it's time for them to pay up, at least the ones in the US, they turn around and ask the government for a bailout, and they normally give them the bailout. And to me, it just seems so insanely irresponsible for a financial institution to have that big of a short position in silver right now, considering
Yes.
all of the market conditions. We've had
They
a
can only bail them out with more dollars. They can't they don't have any silver. They can't print silver, right? At the
right,
Fed. So they can't bail them out with physical silver. So it doesn't really matter. Even if the banks who are short silver are going to get bailed out by the Fed, for instance, they can only help them settle in cash those positions.
good point. Yep,
And that means that the people who think they have silver because they have, long futures contracts, they're going to have to find their silver somewhere else.
right, absolutely.
They're going to have to get their silver somewhere else. Then, because the demand for silver doesn't disappear, if they get cash settled, that only means that they need to get their silver somewhere else. And so, the potential for price appreciation, as we always say, the potential for price appreciation is absolutely explosive. So hold on, just hold on. Don't sell your physical silver yet. Just hold on.
Yeah, and I mean, I really believe it's within the next few years we're going to see a big move, and who knows, it might even be within the next few months. I don't know. And of course, nothing in this video is financial advice, but absolutely hold on to your silver right now. Uh, don't sell it, and don't give them anything to melt down into 1,000 ounce bars, so they can go fill these contracts with them. That's a big part of this game is just being patient.
Yes. For a long while, it seems as though the price of gold is not moving, right?
Right.
For a long while. I mean, like between 2020 and 2024, the price of gold was pretty much moving sideways. And it seemed as though it's never going to rise. And now you see it absolutely going parabolic. So you need to keep that in mind and remember that usually silver follows gold, perhaps with a lag. It takes a while longer, but eventually it happens. This is what we've seen in, prior bull markets.
And in general, I'm not a fan of the term, it's going to be different this time. And, yeah, there might be some situations where that statement is true, but for the most part, that statement is the kiss of death. So when you hear people saying it's going to be different this time, I don't believe them. I know I've seen some posts saying that online, and I just don't agree. And I'd be very cautious to assume that we won't see the same cycle that we've seen in the past. It'll follow gold, and this gold to silver ratio will break down from where it's at right now. I really believe that, but of course, that's just my opinion.
Yeah, that's just our opinion.
Well, Orrin, thank you so much for joining me for this video. Thank you for your insights. They are always exceptional. Um,
Thank you.
You can find links to his X and YouTube accounts in the description below. Thank you so much for watching today. Please don't forget to hit the like button and subscribe to the channel for more content like this. And I hope you all have a great day out there.